Lending can be a complicated area of finance, with varying entities providing different categories of loans that range widely in complexity. An interesting subset of institutions in this space today are structured as various forms of cooperatives, entities like credit unions and cooperative banks, for example. Let's examine how blockchain facilitates this type of financial organization and may even pave the way for increasingly decentralized models in the future. While we can't fully cover all facets of commercial lending, retail, mortgages, etc., let's take a look at some of the common functions performed in the lending process across most types of loan scenarios, and think about our blockchain decision tree and see if there are inefficiencies that could be improved by blockchain adoption. Let's break down the lending process into three high-level stages: an assessment and analysis of the borrower by the lender, the origination and execution of the loan itself, and then the post-trade monitoring and maintenance activities required to follow the progress of the loan. Within those stages, we have generally common activities such as know your customer and anti-money laundering checks, which are often legally required of lenders. And in cases of cooperative lending, we have the pooling and allocation of assets. Then there's the asset origination, where loan agreements are drafted and executed. These loans can be resold in some cases, or their effect on the balance sheet can also impact interbank loans entered into as part of the lender's operations. And after the loan execution, we have activities like credit control and portfolio monitoring, as well as certain legal actions that may arise in specific cases. As things work today, each institution performs its own siloed KYC and AML procedures. You might be familiar with this as how often you're asked to provide driver's license information or passport info, home address, and other personally identifying information. Lenders today also maintain their own rates policies and keep their own records based on their respective vetting processes. Loan issuance details are not typically shared outside the lender, and loans are generally not cross-border. Lending between institutions is bespoke and time-consuming when it happens at all, and monitoring is conducted knowing only the lender's specific arrangement with their borrower, usually blind to the arrangement the borrower might have with other institutions. Access to documentation needed to support any legal action is likewise restricted to the lender's own archives. Blockchain therefore offers potential improvements in a number of areas. Identity solution frameworks, which we'll discuss in more detail later, better protect borrowers and other clients by limiting the amount of personal information shared in KYC and AML processes, in some cases not transmitting the underlying data at all. Additionally, cooperating lenders can begin to work off of a shared ledger of opportunities and optimize the contracts they enter into. Lenders can access transaction history from the cooperative and better vet potential borrowers, as well as see lending and borrowing activity on the network closer to real time. Cooperative lenders can more easily structure peer-to-peer loans, such as with standardized policies, and generate a secondary market for debt. Following loan origination, lenders can again benefit from a shared data source for monitoring updates about borrower activity across markets and geographies, and the cooperative can better manage their collective portfolio as a whole, rather than working within silos where individual lenders might be unaware of activity that is impacting their positions. Such a decentralized store of supporting documentation also streamlines a cooperative's ability to initiate and respond to legal action by increasing transparency and access to relevant records and legal filings.